Hey everybody, Boris. Welcome to the technical update for the COM dollars for July 11th to the 15th. And our theme of yield, yield, baby could not be more applicable than to the COM dollar complex, because this has really been, I think, the stealth story of the currency market. Or if not, I mean, certainly for those of you who've been trading it has been a stealth story, is the relative strength of both the Aussie and the Kiwi. This is something I talked about, of course, last week, but it couldn't have been more evident, couldn't have been just absolutely more obvious than during the non-farm payrolls. As a matter of fact, we traded live in our trading room, the non-farm payrolls, and the first order of business, our first trading plan before the NFPs even came out, we said to ourselves, if it's a positive number, we're buying the Aussie, we're buying the Kiwi, because there's no doubt that the knee-jerk reaction to the downside is going to get bought. And the reason why, of course, is because, as I mentioned in my first video today, it's all about yield. And the only place in the world where yield is left is in Australia and New Zealand. And that's why you're seeing that despite the fact that the dollar is up against cable and it's up against euro, it's certainly not up against the Aussie and the Kiwi. They both have been performing tremendously well against the buck because the yield differential continues to be a very significant attractor of capital flow. So Australia was able to shrug off AAA warning, was able to shrug off whatever nonsense is happening in the election, although it looks like the coalition is actually going to be able to eke out, I think, a small majority win in the Australian election. But regardless, all of the political mayhem that occurred really didn't phase the strength of the Aussie, because the bottom line is the economy in the Australia continues to be relatively strong. It's sheltered away from the turmoil that's going on in Europe right now. China seems to be more or less stabilized, despite the fact that they're definitely walking on a very, very thin line. But demand out of China seems to be stabilized, and for now, the second shoe hasn't fallen against Australia. The complete collapse of industrial demand out of China hasn't really triggered a complete contraction in the Australian economy. And so this week, of course, we have the employment data on the Australian economy. We don't have, I'm actually looking to see what the estimates are, but nobody has the estimates just yet. But everybody's looking at, no, sorry, everybody's looking, we are looking for a small pullback, 10,000 against 17,000 last month, but still a positive print. The market is looking for a positive print in Australian employment. As long as you get a positive print, the threat of RBA rate cuts seems relatively remote, and that keeps the yield going, and that keeps the Aussie going, and that keeps the trade going on the Australian side. The Kiwi certainly just been basically following like a little sister, little brother in its footsteps. There is no Australian data. There's no RBNZ meeting this month, so it's relatively quiet in Australia. Excuse me, in New Zealand, and it still continues to be a huge beneficiary of the whole Asia Pacific flow of capital to those two Anglo-Saxon economies in Asia Pacific. Dollar CAD, on the other hand, has been a completely different story, and this has been one of our favorite themes. We've been exploring it for the last 2 weeks. The divergence between Aussie and Kiwi and CAD, and last week we had Aussie CAD and we could have had Kiwi CAD, the same story. Huge moves, right? There was one of the better thematic trades, and probably is going to continue to be a very, very good thematic trade into this week. I'll explain to you why. Mainly because we have, first of all, of course, we have the turmoil in oil. I mean, if you're trading Canadian dollar, it's just it's a nightmare because every day whatever happens then gets reversed by whatever flows happen in the oil complex. But oil certainly seems to have hit a pretty serious cement level roof of resistance at the $50 per barrel level. Now it's moving back down towards the 44s. If oil comes back down into the 40s, if they broke it, I think, to 42, and if they can break it down to 40, that only just bodes tremendously poorly for the loonie, because whatever bump we had in the oil market, it is not as sustainable as everybody thought it would be, and therefore that makes all of the Canadian oil complex, which is 25% of the GDP, very vulnerable to the threat of bankruptcy yet again. Remember, most of the Canadian oil companies are kind of just living on a day-to-day, week-to-week basis as far as cash flow, depending on whatever the prices the oil market is giving them. And if the oil prices begin to slide back down, and the second time they slide down, remember, the typical dynamic in the commodity is decline, sharp bounce back as you have short covering and everybody thinks that the worst is over, and then a slow, torturous, incredibly painful move back to the downside that lasts much longer than the initial bounce back does, and it's the second cut that's the hardest, and that's what puts the Canadian economy so much into danger. So we really like the Canadian to the shorts. We like dollar CAD to the long side very much thematically this week. We have the Bank of Canada on Wednesday as the major monetary policy event this week, and it's very likely they're going to be far less neutral than they were before. I think they're going to sound the alarm a little bit more about economic conditions within Canada, and they're going to suggest perhaps more easing conditions will be necessary. That's very likely to push dollar Canada to the upside. The only thing that could rescue that trade, in other words, the only thing that could make dollar Canada a strong short, is if somehow oil pops back up to $50 a barrel. That's always a danger, and it's always a possibility, but it's not a probability in our opinion, and therefore that makes the CAD a very vulnerable, sort of the biggest red target of all amongst the majors right now to the downside, meaning dollar CAD is a trade to the upside, meaning that Aussie CAD, Kiwi CAD continue to be very interesting cross trades as we go forward. So resistance in Australia this week, 76 to 74. We moved up in the ranking. 76 is still a pretty strong resistance. We'll take a look at the charts. I'll show you why. Dollar CAD now, 28 is support. Resistance now moves up to 133. We really, we've been flirting with this 30, 31. We almost took out the 31s on Friday post weak Canadian employment data versus strong U.S. Employment data. All of that still continues to weigh on the pair. And Kiwi still showing very good strength on the yield basis. I think we took out the 73, so now 74 becomes the near-term resistance. Let's take a look at the charts here and just see how everything is setting up. So let's look at Aussie first, and we can see I've been talking about this technically, how strong and consistent the uptrend has been. It's just really been holding higher lows. There's nothing more beautiful for somebody who's trading trend than to see, and certainly somebody who's trading uptrend, than to see a series of higher lows, because nothing confirms to you that your thesis is correct than the fact that the lows just continue to be higher and higher and higher. They keep buying every dip. That's really what it's all about. It's just basically the market buying every dip. And so the market right now, obviously 75's got cleared. 76 is a big resist, and you have to respect this. I think it's going to be interesting. Maybe 76.50 will be the peak here. They may push it, but I think the 76.77 is going to have a very hard time just clearing. Let's put it this way: if they bowl through, if they run through the 76 to 77s, it's a very powerful move. That's really almost a blow-off move into the rally. It would surprise me, but could be possible. So at this point, you have to just sort of respect the 76s, 77s as the area of congestion, but it still remains very much a buy to dip trade until and unless the 74s get broken. If 74s get broken, a lot of this technical formation loses its luster. But for now, still looks to be like a very beautiful chart to the upside. And as long as the employment data kind of confirms, the chart should be relatively supportive going forward. Now let's just take a look at a Kiwi because it's a sort of a similar trade. Kiwi fresh highs. We took out the 73s in Friday trade. Very powerful. This is, again, as I said, fresh monthly highs, fresh yearly highs. Very important to pay attention. Do not dismiss this. Technically, when you make fresh yearly highs, it means we're going to go higher. You do not fade. You don't fade fresh yearly highs. You actually join them, or you try to buy the dip. So here, buying a dip means anywhere underneath the 73s to 72s. Support now lies at 71 is a very strong area of support, and certainly we have a chance here to push through 74s as yield baby dominates the theme going forward. And last but certainly not least, here's the caddy. And look at the differential. This is dollar CAD just showing zero strength, right? And caddy showing zero strength, and dollar CAD actually looking still like a very bullish formation. Also, when you're looking at it from a technical point of view, series of higher lows looks very bullish. We ended up 30.35. We kind of probed all the way up to 30.85. But if we take out the 31s, let me just sort of show you visually where this is a 32. The range here is 32, 33. But I think a dovish BOC certainly pushes us into the 31, 32 range. And it doesn't really come to any kind of a slowdown until we can hit the 33s. So dollar CAD remains, to me, one of the more powerful buys. Certainly a buy underneath the 30s, and only a break of the 28s to the downside. If you broke the 28s to the downside, it would completely change the chart. You would then have a chart that is essentially a range-bound chart with a failure, multiple failure at above the 30 level, with a series of lower highs at the 30 level, and that would change the market sentiment towards the Canadian dollar. But it looks to be, from a fundamental point of view, monetary point of view, a pretty strong move to the upside, and we still like it as one of our better trades this week to the upside. So that's how the COM dollars shape up. I wish you guys the best of luck, the best of trading. I'll see you later.